Hi, everyone. I'm Andrew Ritter, partner in Wiggin& Dana's Corporate Mergers and Acquisitions Group. And I'm here today with my partners Heather and Scott for another of our virtual roundtable discussions covering some of the issues and opportunities that have faced companies as a result of the recent crisis. Today, we'll be discussing some of the tax changes that were included in the recent CARES Act, what companies should know about the changes, and also in particular some ways where certain of those provisions can help some companies find some near-term liquidity. So, Heather?
Great, thanks, Andrew. So I'm Heather Rahilly. I'm co-chair of the private equity group here at Wiggin & Dana. I'm here with my colleague, Scott McClure, partner in the tax group, also here at Wiggin & Dana. And Scott, thanks for coming. We have just a few questions here that may be relevant to some of our clients navigating this new landscape and the legal developments coming out of it. So I think, one of the big questions on some people's minds are what are some of the biggest tax-related developments coming out of the CARES Act, and second part, maybe not so big, and maybe overlooked by some, but some of the provisions and changes that can provide liquidity to taxpayers.
Yeah, no, those are great questions, obviously very relevant for the situation currently. I think the biggest things coming out of the CARES Act, the ones that got the most headlines, were the various tax credit and deferrals that are available to taxpayers in the current year. Obviously, they provide immediate relief and can actually make a significant dollar impact on taxpayers' current businesses. One of the biggest in that regard was the employee retention tax credit. That's available to all employers who are affected by COVID-19, either through a partial or full suspension of their operations or a significant decline in their gross receipts or revenues. It's available to employers for wages paid between March 13 and December 31. And it provides immediate relief because employers can take the credit. It's up to $5,000 per employee. So you get 50% of their $10,000 in their qualified wages. So it works out to about $5,000 per employee. And you can take that credit against your current employer tax, the employer's portion of the payroll tax that's paid each month or quarter. So it provides immediate relief, and it can be very beneficial in that regard. One thing to note with respect to that credit is that it's not available to any taxpayer who's taken advantage of a Paycheck Protection Program loan or an economic injury disaster loan. Both of those are SBA loans currently available. So if you've taken advantage of those loans, you're not available to take employee retention credit. That's probably one of the biggest things coming out of the Act. Another very significant tax credit was the ones that are available for employers who are affected by COVID and have to provide sick leave or family leave for employees who are directly affected by the COVID. And it's available to small businesses, employers with less than 500 employees. But again, it's a tax credit, and it's available 100% of the wages that are paid to, in either of those cases, for sick leave or family medical leave, is fully creditable against, on a dollar-for-dollar basis, against the employer's portion of the payroll tax. Now, wages that are paid for that purpose are not also counted for purposes of the employee retention credit. So employers can't double dip and receive both credits for both the wages paid in both instances. But one good thing about this credit is that it is available to employers who take advantage of a PPP loan. So it has greater availability in that regard. The last big headline probably that I can think of coming from the CARES Act is the employer tax deferral. That is available without regard to whether or not the employer has been affected in any way by COVID. And it's also available to all employers, regardless of their size. But it provides 100% deferral of employer taxes, payroll taxes, between March 27 and December 31, without penalties or interest. And those amounts are deferred 50% until December of 2021 and 50% until December of 2022. So it's extreme deferral. It's very taxpayer favorable. The one note on that is that for taxpayers who are taking advantage of the PPP loan, if and when that loan is forgiven by the SBA, then at that point the deferral stops. You can start deferring and continue deferring while you're applying for the loan, while you receive the loan. Once you receive forgiveness for the loan, then as of that date, you have to stop deferring. The previous deferral is okay, but all further deferral at that point stops. But again, very taxpayer favorable.
Right. Do you think, Scott, I think we spoke about this the other day, but do you think that taking advantage of, these credits is going to put you companies at a greater audit risk? Just like taking the PPP loans, the government's going to, take an aggressive approach on eligibility and, whether those credits were taken accordingly.
Right. Well, it certainly wouldn't, particularly with the employee retention credit, since it's absolutely prohibited to take if you have a PPP loan. It seems like a fairly easy check for the government to make. If someone's taken the PPP loan, and then whether you wouldn't be entitled to that at all to the employee retention credit. The payroll deferral is a little more complicated for the IRS check, but I mean they could easily, I think, determine the forgiveness date. All deferral up to that time is okay, but after that, it's not. So I think in either instance, it could potentially, increase the audit risk. Probably not as much with the family medical leave and the sick leave, because those are fully available whether or not you get the PPP loan. All of these are relatively complicated to calculate, so it does, in that regard, put the deferral is not as much, but the other credits are fairly complicated to figure out in terms of the actual amount of the credit. So it seems like it could be right for possible audit.
Right.
I think your second part of your question deals with what other sort of more overlooked items or items that were not quite a big a headline in the CARES Act for tax purposes, but could have a significant impact. One of those is the changes that were made to the net operating loss provisions. In order to fully understand that, you have to take maybe a 1-minute history lesson, and that is that prior to 2017, net operating losses of corporations and individuals could be carried back to prior years, 2 years prior, either of those years, and then carried forward to 20 years. So if you had a loss in a current year, you could carry that back to a year of the 2 prior years in which you had net income and offset those losses. And offset that income, and the income was fully offsettable by the loss. 100% of the income could be offset. There was no restriction. That changed in 2017 because of the Tax Cut and Jobs Act. As part of that act, the Treasury made a change that all losses can be carried forward unlimited, to an unlimited degree, but are not able to be carried back at all. So it sort of eliminated the immediate liquidity aspect of having a net operating loss in the current year. In addition, to the extent you do offset income with net operating losses, you can only offset 80% of that rather than 100% under prior law. So both of those were fairly significant changes. The CARES Act, as part of its effort to provide relief to affected corporations and individuals, changed those rules temporarily. So the new rule is that net operating losses in the current year and 2019 and 2018 can in fact be carried back, or will in fact be carried back for 5 prior years, and then may be carried forward. And then also income that it can be offset by the net operating loss is now 100% rather than the 80%. Both of these changes impact only 2018, 2019, and 2020. After that, the prior limitations set forth in the Tax Cut and Jobs Act will come back. These changes actually have a really favorable benefit for taxpayers, because what it does is allows losses that are determined in years after the Tax Cut and Jobs Act and at a lower tax rate, because that act also changed the corporate tax rate from 35 to 21%. So if you have a loss in those years after that, 18, 19, or 20, you can take that loss and offset it against years prior to 2018, in which the corporate tax rate was 35%. So it's a nice opportunity for arbitrage of tax rates for taxpayers. There are a couple of technical items that have to be remembered when you're looking at the credits, and then looking at the NOL offset. And that is that you can elect out of the carryback, but if you are going to take the carryback for prior years, you have to take the carryback for all 5 of the prior years. Not just, you can't say, okay, well, it's carried back to 2013, but I don't want to have carried back to 14 or 15. It has to be for all of those years consecutively. You can separately elect for each of the affected 18, 19, and 20 tax years. So you can elect to carry back an NOL for 18, but not for 19, or vice versa. In order to fully take advantage of it, taxpayers are allowed to either request a refund, go back and amend their tax return for the affected year. So you can carry back the 2018 loss to 2013 by amending that tax return, or you can apply for a tentative refund using a separate form. Now, one thing to remember is that you can't carry back a net operating loss if you haven't filed the tax return for the year in which the loss was incurred. So if you have a net operating loss for 2019, you won't be able to carry that loss back unless and until you file the tax return for 2019. So that's somewhat impactful because many taxpayers have not yet filed their 2019 tax return because of the deferred due date that was provided as part of taxpayer relief this spring. So it would behoove taxpayers, if they're going to have a loss for 2019, to go ahead and get that tax return filed so that they can then carry back the loss. The quickest way, as I alluded to, is to request a tentative refund by filing for a corporation via Form 1139, and for individuals, Form 1045. If they file that form, then they can get the IRS to make a tentative examination of the claim, and they're then required to provide the tentative refund within 90 days, generally, of filing. So it's a way to get fairly quick liquidity from a current NOL.
Right. And that's before, and then you file at the regular deadline. You file that interim form and then get the tentative review and your refund, and then make your full tax filing for 2019.
Well, you would have to actually make the full tax filing for 2019. You'd have to file your tax return before that loss is allowed to be carried back. The Form 1139 allows you to not have to go back. If you're going to carry the loss back to 2013, let's say, or 2014,
right,
you don't have to fully go back and amend that tax return. You can just file the Form 1139 for that year.
Got it.
And they'll just make a tentative review of it rather than having to review a completely amended tax return.
Right.
The one important item to note, though, is that for 2018, the ability to make that sort of fast filing on Form 1139 should have expired as of December 31 of 2019. But the IRS has provided a 6-month deferral for taxpayers to make that claim. But that 6-month extension expires June 30 of this year. So basically a month from now.
Right.
So it's very important for taxpayers to remember, if they're going to carry back their net operating loss from 2018, they need to make that decision sooner rather than later.
Right. Thanks. Good point.
Yeah, I mean, I've definitely talked to a lot of people that are looking for additional liquidity unexpectedly and looking a lot of different places. And I think, the obvious place they're looking in the CARES Act is the EIDL and the PPP loans. But, we brought this up, I think, a couple of weeks ago. We were talking about it. It's an interesting way to, use the CARES Act in a creative way and
Right.
liquidity people need, at least when it's available. You talked about the automatic NOL carryback and how, you can elect out of certain elements of it. I think that's an interesting option. Can you talk a little bit more about why someone would want to elect out? Like what kind of drivers would make a company make that decision?
Yeah, there's a couple of instances, Andrew. Probably the most common one, and is actually comes into play with an exception to the automatic carryback that you have to elect out of. For certain taxpayers, particularly multinational corporations that have subsidiaries overseas, there is a provision in the code now that requires those taxpayers to include in their income certain deferred earnings from foreign subsidiaries. And that income that gets included is typically taxed at a lower rate than would otherwise be in effect. So for those years, you may not want to use your NOL carryback for those years. Now the IRS does, in fact, for those particular instances, provide one exception to the rule that you have to carry back to all years. You can elect to carve out years in which you had what's called a 965 inclusion for these foreign subsidiaries. So that's one instance in which you can specifically elect out 1 year. Otherwise, taxpayers would want to consider whether they want to elect out completely out of the carryback if there are years, prior years in which you used certain tax credits, like foreign tax credits, and carrying back a loss from the current year would displace those credits that might not otherwise be usable. So it may not be tax efficient overall for them to do that. Also, carrying back income to a prior year could affect the alternative minimum tax calculation for corporations and individuals. So the impact, you may end up not saving money at all because of a negative impact on alternative minimum tax. So taxpayers would want to consider very carefully the ramifications of both the 965 inclusion as well as the impact on other credits, tax credits, and alternative minimum tax.
Yeah, that's great. Yeah, thanks, Scott.
Great, thanks. What about for pass-through entities, Scott? LLCs, S-corps, partnerships. Are there any changes that can help them and their owners get some liquidity in these tighter times?
Yeah, of course, the big thing to remember with all of those kind of entities, they're not themselves taxpayers, and so the impact here would be on the individual owners. But yeah, there is absolutely an impact for that, in that the CARES Act did try to make a change that would sort of correspond to the changes we just talked about for corporations and individuals, their individual earnings directly. So again, you have to take a step back and look at what's happened prior. The Tax Cut and Jobs Act, again, sort of changed the rules here. Prior to that, to the extent that owners of pass-through entities like S-corps or partnerships or LLCs had losses from those businesses, those losses would not only offset business income, but could, to an unlimited extent, offset their non-business income, things like wages and dividends and interest and capital gains. The Tax Cut and Jobs Act made a change in that regard. It said that they could still offset, obviously, their business income with the pass-through losses, but they could now offset non-business income only up to a limited extent. So $500,000 for married individuals and $250,000 for single filers. Again, this is of the owners of those non-tax-paying entities. There was some confusion, I think, in the Tax Cut and Jobs Act as to whether or not how wages would be applied in that instance. Would they be treated as business income or non-business income? But nonetheless, the rule was that there's now a limit, where there was not one before, on their ability to deduct these pass-through losses. Obviously, given the limits that were set by the Tax Cut and Jobs Act, 250 and 500,000, the universe of taxpayers affected by this isn't huge, but it certainly had a large impact on a large number of taxpayers. There was a lot of unhappiness about this change. The CARES Act did make some allowances in this regard, again, for years after the CARES Act, the Tax Cut and Jobs Act, so 2018, 2019, and 2020, up until 2021. The CARES Act suspended the requirement that you can only offset up to 250 or 500,000 of non-business losses with these flow-through business losses, of non-business income with these flow-through business losses. So for those years, these flow-through business losses are fully offsettable against all income.
What about the wages for the loss limitation? When the loss limitation comes back in 2021, has there been any resolution or clarity about how that's going to be handled, how wages are going to be handled?
Yeah, there were a couple of technical corrections that were set out in the CARES Act to the previous changes that were made by the Tax Cut and Jobs Act. There was quite a few, glitches in the prior law, as it was passed rather quickly. So the CARES Act did try to clear up some of those glitches and ambiguities. And one of them, which they did, was the they clarified that wages will in fact be treated as non-business income. So when the limitation springs back into effect in 2021, then those business losses will in fact not be able to fully offset wages that the owner also earns from that business.
Yeah, that's good.
Yeah, that's all good stuff. Scott, have you seen anything based on these new changes from the last few months? Have you noticed anything in M&A practice? Any reps, anything new that's come up as a result of these changes?
Well, so far, the main one that I've seen is we have seen buyers asking for representations from sellers in some instances of whether or not they've taken advantage of any of the credits that we talked about at the top. I think it's valuable information for buyers to have.
Right.
If they've taken advantage of those credits, they would want to know, A, were the credits determined correctly, and B, what sort of limitations that then puts on their ability to get a Paycheck Protection Program loan or one of the other loans that's been made available through the SBA. So that's one that we have seen. I think it's also possible we will see additional reps regarding net operating losses and whether taxpayers have elected out of the new carryback provisions. Tax sellers are typically fairly reluctant to provide many representations with respect to their NOL situation.
Definitely.
But I think that's one that does not go into evaluation with respect to their NOLs, and also doesn't go into ownership changes and the potential impact of ownership changes on the availability of the NOLs, but is more of a factual determination as to whether or not they elected in or out of the credit of the carryback. So it seems to me that that's one that we could see as well.
Right. No, I think that's a great tip for both, on the buy side. I think, that's definitely something we need to be aware of and ask for and make sure that diligence those calculations, and especially in the heightened, audit and regulatory environment that's going to surround this in the next few years. I think that's really important. And then, on the sell side, just to know that, when you do take advantage of these credits and make these calculations and you're looking at a future deal, that, your people are going to take a look at this and you're going to be asked to stand behind your reps for it.
Yeah, absolutely. I think, as we've talked about, I think we're going to see that even more generally with respect to Paycheck Protection Program loans. There will be, there's so much that goes into the determination of that, and so the ramifications of making a mistake in the application of that loan or the forgiveness of that loan are fairly significant and have significant ramifications. So I think we'll see, as you indicated, additional representations around those processes, as well as all the tax benefits that we discussed.
That's great. Thanks so much, Scott, for all your insights, and thanks for Andrew for moderating with me. And our audience for listening in. We have some other parts coming up in our series, new developments in CFIUS, litigation, and immigration in this new COVID environment. So please tune in, and thanks everybody for listening.
Thank you.
Thanks everyone.